So in the last session, we covered a bit of time on charting options, charting for options trading, what kind of websites you can use. And so that was a little bit of contextual information, not so much conceptual, but practical contextual information as to how to use long-term data on eyeballs and stuff. And then we spent a lot of time understanding why early exercise is not done even for American options where you have the choice of early exercise. So we spent some time understanding that. We did a bit of quizzing and stuff like that on intrinsic value, time value, etc. So that's our work for the previous session. So we'll start off today we'll continue with the topic which we just started in the last session, which is, let's keep going down here. Right, the 4 decisions after the initial transactions you have to worry about. Okay, so this reminds me, in case I ask a question, I will try to move this thing out of the, we'll see. Okay, so this is what we spent a lot of time in the previous class discussing. All right, so choice prices, a little bit of information. Okay, now here we have to talk about this topic. I'm going to rename this topic here. I mean, the topic was the subtopic was relationship of the SPX and the VIX index. Okay, SPX is referring to the S&P 500 index. Okay, so just to make it clear what we are referring to, S&P 500 index. I'm not going to write index, okay? You have to understand that as index, because it will take up too much space here. So S&P 500 is an index, so you have to understand that. So SPX is just the ticker on many charting systems. On Yahoo Finance, it will be caret GSPC. So yeah, if you see here, you'll be caret. Yeah, if you do caret GSPC here, you'll get the S&P 500 index. So this is just a matter of knowing the syntax. Right, so this was the name of the subtopic, but I'm going to change this and make it a more general topic. Okay, the more general topic actually should be, because we have to learn everything at as general a level as reasonable. The name of the topic is going to be intermarket correlations. Everybody's familiar with correlations, okay? Intermarket, sometimes you might refer to it, I mean, just write without the hyphen, but I'm writing it with the hyphen. Okay, intermarket correlations, what do we mean? That is, this refers, why do I not have big font size? Let's have at least 14. Let's have. All right. Refers to cases. Instead of writing phenomena, I'm writing cases where our cases would not be very good, but it should be instances. That would be much better. Instances where two different markets, okay? And so when we say markets, remember we are always talking about market instrument combinations, because you never see the price of anything without it also being some type of instrument. Okay, so when you're looking at, when I say we're looking at spot prices, when I say we are looking at spot FX prices, then we're always looking at some kind of market instrument combination. So that's very important to understand, that we are looking at, if we are looking at any kind of prices, we're always looking at prices for some market instrument combination. So we're two different markets. Markets are always seen trading in the form of some instrument or the other. It's either spot, futures, options, swaps. So you look at two different markets, refers to instances where two different markets tend to move together. Okay, so this idea of this relationship with SPX and VIX, this should be really studied at the level of generality, where we have introduced the topic of intermarket correlations. So tend to move together, okay, i.e. So let's do a little quiz to see who is sleeping. Let's ask Rashi. So when I say two markets tend to move together, they exhibit high correlation or low correlation?
Sir, am I audible?
So the question is, if I say that two different markets to move together, that means that they would exhibit high correlation or low correlation?
High correlation.
High correlation. Good. Very good. Okay, so that is, they exhibit high correlation. Okay, so this is what it does. So one of the things you will find when you read certain textbooks, or not so much textbooks maybe, but market-related books written by practitioners, you will find that there is a lot of discussion about this intermarket correlation. So one example of that is, now high correlation means, let me clarify this, high absolute correlation, okay? That means highly negatively correlated is also covered in this, okay? So high absolute correlation, which means you could have a very inverse relationship between two variables, and that would also be covered under this statement, okay? So high absolute levels of correlation. Okay, so maybe we should put this here, high correlation. Okay, so negative correlation. So I'll give you an example. We can use our example here of which we saw yesterday to some extent. Okay, that we can stick to that example actually. Then since we have Microsoft here, what is meant by this statement, this general statement, is that, remember, these two are two different markets, okay? Because these are two different market instrument combinations, although there is a commonality in that both of them relate to Microsoft common stock. So what is the first market? The first market is the prices for the common stock of Microsoft Corporation. So you can track that here, the left-hand index. So it's around 210 or something like that, okay? 214. Now, this is one market. So this is a spot instrument. The assets are common stock of Microsoft and US dollars. Remember, every market is a venue for exchanging two assets for each other. So in any market, you should be able to identify what are the two assets. In this case, the two assets are common stock of Microsoft and US dollars, and they're being exchanged in a spot via spot instruments in this case. Here, this is an eyeball index, so you can just say, index of options, an options index for options on the common stock of Microsoft. So the instrument is options, okay, and this is an eyeball index. You're buying and selling. If you're buying and selling this index, then you're buying and selling options as a general category on Microsoft. So these are prices for options on Microsoft common stock. So this is also a different market. This is the market for options on Microsoft common stock. And so here in this market, the two assets are, okay, if you imagine, of course, this is an index, so it's not really, you can trade it, if you could trade it as an index market directly, which you don't have for individual stocks, but we will imagine it to be the case, that you would have a bundle of options for Microsoft common stock. It's like a basket of options on Microsoft shares, and that would be one asset, and the other asset would be again US dollars. Okay, so you will be exchanging this bundle of Microsoft options for US dollars. So this is an options market, and this is a spot market, but they are different markets, and there are two different markets. So what we are saying when we talk about this general topic of intermarket correlations is that there are two markets and there is some kind of high absolute correlation here between the two markets. Okay? So here a high absolute correlation means high negative correlation is also included in high absolute correlation. So you would point towards times like this where you see this here as the COVID crisis hits, the market realizes how severe it is, and the asset price starts to fall, the underlying asset price, shares of Microsoft, this market starts to decline, this market starts to rapidly rise. Okay, and again, as you see here, the top here and the bottom here are almost at the same time. And as the stock market, as the prices for shares of Microsoft start to recover and start moving higher, okay, as that happens, you see that the option prices start a steady decline, right? So, so people would point to phases like this, kind of here, okay, up until here. Let's say we have a very clear negative correlation between here and here, okay. So we could actually highlight that by dragging the, if you really wanted to highlight that part, this is what you would do. Kind of here, okay? So you see the prices declining here and the eyeball increasing, then the eyeball decreasing as the price increases. So this is what you would point to, okay? So now this is the case of high negative correlation, okay, and this is included in the high absolute correlation. Now the point to understand about this, a very important point, is that sorry.
Excuse me, sir.
Yeah.
Sir, sorry to disturb you. I just had to inform that Kanika is just joining. There's a power cut in her area.
That's okay, no problem. This kind of stuff you can put in through the chat box. Okay.
Fine, sir.
Okay. All right. So the point about this this intermarket correlations is that these can often exist for some time. Okay, we don't know how long that is. They may differ from markets, between markets, differ between times. They can exist for some times, but they are okay. So the implication of all this is that okay, so you have to be, well, let me put it this way, maybe very reliable. If you have a short-term correlation, so you have to have the main thing I want you to understand here is I want you to have this kind of skepticism, because one of the things you'll see in the markets is that people will try to pitch you trading systems by saying, wow, look, there's this inverse correlation, and then I find this this thing is there, therefore now I think prices are going to go up, therefore option prices, eyeballs are going to fall. Now the problem with all this, of course, is that as you can see, even in a short-term, even with short-term data like this, when we don't have much, actually we have only from kind of late 2018 to today, about 2 years of data, you can see that there are periods where this thing doesn't really hold. okay, where it doesn't really hold. Of course, you can see here once again as the price takes off, the eyeballs start to collapse. Okay, so all these things happen, but the point is again they're not very stable. Where you can see here that there is a part where the prices are going up and the eyeballs are also going up. So the point is that you will see these kind of relationships from time to time, but you should not become enamored of these relationships because they are not stable over time. Almost always they are never stable. So therefore there is a variation in the strength of the correlation. So you have to be very suspicious of these relationships, and that's why I'm saying that these are not very reliable trading strategies, that they are almost always unstable. The correlations are unstable. So you have high correlation sometimes, but what I mean by unstable correlation means it's not constant and it can often become weaker over time. So this is what you have to be aware of. So when people talk to you about these relationships, you should be a little bit skeptical about that. Okay, but it's still important to be aware of this. And in particular, in the case of equities, this website is giving us a lot of trouble. So you'll see what comes up here. Okay, so in the case of equities, you do have this negative relationship, and I've shown you this, and we can see here if this chart is there still working. We'll see about this, the same thing, but first let's understand the Microsoft relationship. So in the case of equities, the specific case of let's put a subtopic, another subtopic under this, okay, intermarket correlations. Under that, we have this concept. We'll move this to the side. So this is a topic of underneath that, okay. So we'll say that in equities, okay, this is a inverse relationship between eyeballs and underlying. So I'm writing underlying in the short form so that it fits in one line. Okay. So in equities, this shows up. So this is a general principle. The general principle is intermarket correlation. So you can even later on have correlations between. You can start looking at correlations between things like crude oil and you can look at correlations between gold and the US dollar index, things like that. So that would be a case of not involving equities, that's currencies and commodities. So you could do that as well. You could look at so you will come across many of these discussions, okay? So when you come across these discussions, it's important to understand that, so you will come across this discussion not just in the case of equities, which we have just discussed with Microsoft, but you will come across this in many different kinds of asset class contexts. So here we have the price of gold, and some people might say that I'm going to compare it to, okay, I think if we have USDX, is that the US dollar? Is that the, I forget the name, the ticker for the US dollar index. Anyway, never mind. We can just look at one major US dollar. So this is a case of gold prices. So in gold prices, you have gold as the base asset and US dollar as the terms asset. So let's look at something else, which is like the euro. Let's compare it to the euro. And which is also a case where you have the US dollar as the, okay, so it's not very well, but you can see some correlation. It's another case, the euro is another case where you have the US dollar as the terms asset. Okay? So you can see some correlation, as gold prices are going up, and the euro is also going up against the US dollar. But here again, you see some divergence as gold prices are coming up. The euro-US dollar is the euro is still moving up against the US dollar. Here again, you see some correlation. Gold prices are dropping, and the euro is also dropping against the US dollar. All right. So these are the kind of things that people in the market are going to point out to you. So you have to understand when these are being pointed out to you. So here you see another example of intermarket correlation. This is a different market. US dollar is common to both markets. So one asset will usually be common, okay, and US dollars be common to both markets, and but the base asset is different in each market. And the base asset is what is being traded. So here the base asset is gold, and here it's euros. So you can see here there is some correlation, and people will point out these kind of correlations to you and say, they'll put out a nice report and say that, look, we have these correlations. Now I believe that gold is going to go up, so therefore the euro is also going to go up. And these kind of statements will be made. But you have to remember that these are, this is when you have to remember what I've taught you here, that you can have these kind of cases, but they are not stable. They change over time, so it's not very reliable as a trading strategy. Okay, so so that they can exist in any asset class. We can write this. Can exist in any, in or across any asset class. And so since I've said I have to put this, okay, can exist. So which I've just shown you one example where we looked at between gold and euros. So that's involving commodities and currencies as asset classes. So you have two different markets in two different asset classes which are moving together, but then the correlation is not stable. So sometimes you can have the same asset class here across two different instruments. For Microsoft, common stock, and for options on Microsoft common stock. So as the common stock price declines, the option prices tend to increase, and as the price rises, option prices tend to decrease. So so this is the idea of intermarket correlations. So what is happening here is where we stopped yesterday is this part where we already explained the underlying the relationship, and this you can check. I'll just click on this once and see if it works. A lot of the CBO links. This place is called the CBO. It's the world's biggest. I still think it's the biggest. Yeah, because their website, they're trying to change their website. This used to be called the Chicago Board Options Exchange. It's one of the first exchanges to start trading equity options. And it started in the early 70s. So pretty pioneering place. It's, if you go to Chicago, you can still see this in downtown Chicago. You can still see this building. So you have the CBO here, and you can see the same thing that I showed you. You can read this on your own later. And you can still see what the same thing that I showed you in the case of Microsoft, stock prices and options on Microsoft stocks. The same thing you can see here. This is a very well documented index relationship that you can see. Therefore, you can see it here on the CBO website as well. And you see the same thing, that here as the S&P 500 rises, which is the index of stock prices, as stock prices rise, prices of options on those stocks generally tend to decline. Okay, this is a little bit of a decline here. So these guys are rising here, option prices. As stock prices rise, option prices decline. So this is the relationship here. Okay, you can see some mechanical, some kind of empirical documentation. All right, this kind of relationship number. And so usually when you look at reports that will come out from the industry, okay, analysts will put out these kind of reports. Another thing you have to remember is these numbers are nothing but the documentation, the numerical representation of what you see here visually. So when you see these kind of numbers, now this is something that nobody else will teach you. So make sure you understand this carefully, because some of these people may not even be aware of this problem. But people tend to get very impressed by numbers. You know, human beings, there is a problem that human beings have, that when they see numbers, when they see quantitative, lots of equations and stuff, people start to think that that is very real. But it's not the same in every discipline, and especially in finance and economics. They are not very reliable most of the time. So you have to remember this. These kind of numbers that they have generated here, these are only good for the historical data set that you have here. If you take a different data set, okay, at any point of time in the future or even in the past, you could well end up with a different set of numbers, okay? And you may have seen this yourself when you have done your beta calculations. When you've done your beta calculations for your capital asset pricing model, you might have noticed this yourself, that if you change the data set, instead of using one data set here, if you go back 5 years, or you go forward 5 years, and you use a different data set, you'll come up with different numbers, okay? So that, be very careful. These things should not be taken seriously as having any kind of predictive value, and they should be taken as good only for the sample that they're taken from. That's it. There isn't enough regularity in the underlying asset prices to be able to make predictions based on this. But this is what a lot of people will do in the industry, and certainly in academia and textbooks. You won't even find a mention of what I'm saying to you now. But this is a very important thing, what I'm telling you now, that you must not take these numbers too seriously. They are only good for the data set that they are calculated from, and that's it. They're not good for anything else. So don't ever forget this, because a lot of the modeling that is done in finance suffers from this problem, and that's why you find that finance and economics models their performance is very poor, because they don't understand this problem. Okay, they don't seem to understand that there's a problem. Whereas if you're dealing with other subjects like aeronautics, astronautics, those kind of areas where things are stable, okay, they're not like stock markets and economies, they're very stable, so you can actually do predictive modeling with mathematics. But here it's pretty much useless actually, but people still do it because it feels good. Mathematics feels good. It gives them a feeling that we are dealing with something certain. So these are all human weaknesses. So we are discussing this main topic here. As you can see, the general topic is intermarket correlations, and we are talking about a specific relationship in equities, since you're dealing with equity options. Yes, what's up?
Sir, you said that these are only good for past historical data, these types of models. But
Yes.
sir, there is also the concept of that cyclicity of markets, that they tend to repeat after some times. So can't these models be helpful during that time? Like it is said that if the market is booming too high, it is tend to fall, like it happened in 2008, and then this COVID came. So the reasons may be different, but that cyclicity got completed, and so these models cannot be helpful in predicting that type of cyclicity.
There is, you're right, good point actually, good point that you've raised. So it's not, don't say cyclicity, it's a cyclicality. The word is cyclicality, okay?
Okay, sir.
Cyclicality, but I understand what you're saying. Okay, so what you're essentially talking about is that if we remove this now, let's say, yeah, okay. So let's say we can look at any market. We can even look at gold and see the cyclicality in gold. Okay.
हाँ हाँ ठीक है हाँ 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 ठीक है मैंने पूछ के करूँगी.
I can mute her. Okay, good. Okay, so let's look at yeah. So what you're saying is cyclicality, you're talking about cyclicality in prices, and you're talking about that, yeah, what you're saying essentially, so you do see some element of repetition in the sense this kind of a sawtooth pattern, higher highs, higher lows, you see that everywhere, okay? Whenever there is any kind of trending movement in the market, you will see that kind of movement, and you see the cyclicality as well, going up, coming down, okay? So you see some element of cyclicality there as well. And so you see, yeah. So the response to your question was, so what I'm trying to say here, let me clarify what I'm trying to say here, is that these kind of, strictly speaking, what I'm saying is that these numbers, okay, I don't know if you can read the numbers, but these numbers that they have, these numbers are only good for the data set that they're calculated from. This particular data set running from this starting date to this ending date. That's what I'm saying, okay? So what I'm saying is you would have seen this yourself in beta calculations while doing CFPM analysis, that if you change the data set for the same market, okay, for the same stock, you will get a different beta number, okay, because the data set is different. So what I'm saying is that if you change the data set, you will get a different set of numbers. So the answer to your question essentially is, so that's why I'm saying that if you do mathematical modeling, predictive mathematical modeling, mathematics is a very rigid, it's a very powerful tool, but it's also very rigid. So once you say that, y is equal to root of x, then you are stuck with that once you have defined it that way. You can't then say, no, actually now I think for this period, y will be equal to 1.5 times root of x. You can't do that once you've given the model like that. So what I'm saying is that when you go to a different data set, like when you go into the future, okay, these numbers are very likely to change, and they may change quite dramatically because the systems and when you look at markets, actually, these are not stable systems, okay? When you look at markets, they're highly unstable systems. You can see how much movement there is. And therefore, what I'm saying is that, yes, you're right. There is some general repetition. So, but what I'm saying is that when you do mathematical modeling, you're talking about very specific numbers, okay? You talk about very, very specific numbers, like you're saying the wind speed will be 2 times whatever, or the aircraft can fly at 2 times the speed of the headwind, etc. Those are very specific numbers. Now, in the case of subjects like aeronautics and physics, you can make those statements and they will always be true because the systems are stable. Now, here what I'm saying is when you make a mathematical prediction, okay, using a mathematical model, you will be predicting certain specific numbers, right? And you understand what I'm saying, Utsav? You will be making specific, you may be making specific forecasts. Now, what I'm saying is that those forecasts are very unlikely to come out to be true because these numbers are going to change and they could change dramatically. So there is going to be some relationship. You can see some similarity. There is a pattern of highs and lows that you can see, okay? But very specific prediction is not likely to work out because the system is the underlying system, which is the movement of gold prices, as an example here, okay, and the movement of any market price, the movement of any kind of economic data, the process that is driving these things is very unstable. It's essentially human expectations. So therefore, the process is very unstable. So these are not systems where mathematical modeling works very well because mathematical modeling makes very specific projections and the specific projections are unlikely to work out. But that does not mean, as you correctly pointed out, that there isn't some kind of general prediction, pattern that is developing. There is a sequence of highs and lows that you can define an uptrend with a sequence of highs and sequence of higher lows, higher highs. You can do these things. So the answer is somewhere in between. Am I making sense in what I said? So the question is a good question, but am I making sense in what I'm saying?
Yes, sir. Sir, it implies that it might not be accurate, but it might have a loose relationship with the trend. We cannot accurately predict that if these are the numbers that this is going to happen accurately.
Correct. Very right. You're getting the right hang of it. So when we do prediction in, say, for instance, in aeronautics, and when you do any kind of, like when you launch a ballistic missile, like when Iran launched some ballistic missiles against US bases in Iraq, they didn't want to kill any people, so they actually informed the Americans as to where those ballistic missiles were going to land and at what time. And they could predict that exactly because those physical systems, the gravity of the earth does not change. We know how the wind behaves on based on the mass of the missile. So in areas like that, you're dealing with things which are stable. So you can actually the missiles landed exactly where the Iranians said they would land. Because in the case of ballistic missiles, you can actually make those kind of predictions, okay? Because the system is stable. The gravity of the earth doesn't change. The nature of wind resistance doesn't change. Whereas when you're looking at markets, all I'm saying is that don't fall in love with these kind of, wow, I've got a mathematical model. This is so great. I'm looking at when human beings get seduced by numbers. When they look at mathematics and numbers, they think that this is real stuff and this is very predictable. So, but then in the case of markets and economics, don't get fooled by those numbers because these are not going to be reliable in a very precise sense. Okay, you can look for general relationships, but don't be careful that be aware that these numbers are not likely to hold up in a precise sense, which is why a lot of people lose money in markets because they lose sight of this. Okay, which is the same point that I was trying to tell you when I if you remember, when I was talking about these valuation models, okay, the valuation models that you do, why these are subjective models? Because these are all based on forecasts. Your project NPV is based on forecasts, and your stock valuation is based on forecasts. That's why different people have different estimates of the fair value. And that's why many people can have the actual reality turns out to be very different from their forecast of fair value. Why? Because the forecast that they made turned out to be not correct. Okay, so that's basically what it is. Okay, so even Warren Buffett, say when he bought, I think he bought Heinz. When he bought Heinz, he overpaid for that stock. Later on, he didn't realize then, of course, but then they had to write down the value of a lot of assets. So he lost almost $11 billion, or $9 or $11 billion on that acquisition. So that again is a case of valuation where he overestimated the fair value of the stock. So that's the thing, so that they don't turn out. So it's essentially the same thing that I was telling you here. So the reason I'm emphasizing this so much to you guys is that because you will not hear this anywhere else, okay? Most of the places when you hear about all this stuff is, any kind of modeling, you will just, there is a focus on the technique, which you need to know the technique, that's fine. But my duty incrementally is to also inform you that be very careful about relying too much on these models in the real world, because the real world market systems are not stable. Okay, so that's what I'm saying. Yeah, okay, so now you've understood that. I think Utsav has clearly understood that, and hopefully the rest have also understood. Okay, so here we are going back to this thing. So I just wanted to spend a little bit of time giving you that warning because you will not get it anywhere else. And I think that warning is important for your survival. So remember, in teaching you, my goal always is that I have to protect my students. They should not fail in the real world because they were not taught certain important practical considerations, which you may not find in the textbooks. So I want you to be able to survive in the real world so that if you survive long enough, eventually you will prosper. Okay, so now we are coming back to this, the equity relationship, because you're trading equity options. So we are talking about this equity relationship, inverse relationship between the SPX and VIX. That's one. And you just saw Microsoft. It's the same thing. This is just a basket of equities, and this is the option prices for options on the basket of equities here. Same thing, and that you see here. Now, why is this happening here? Okay, so this is what we need to understand in the case of equities. Okay, so the reasoning for this. Okay, so let's write this. Maybe we should ask people initially just a little bit. So what happens is that the theory behind this is that as asset prices tend to fall, Okay, as you can see here, as it starts to fall here, the VIX is the index of equity options on the S&P 500. So you can see here, as the S&P 500 starts to fall, okay, the VIX starts to rise, okay, which is the same thing that you saw in the case of Microsoft. So what is the reason behind this? Okay, so I don't think they've given this here, so I mean, I'll write it for you and I'll explain it. But the reason is based on hedging behavior, okay? So the explanation lies in hedging behavior. All right, so the explanation lies in hedging behavior. We have to change the font also. All right, so we'll come to that. The explanation lies in hedging behavior. All right, so let's try to understand the hedging behavior. Okay, what happens? This chart is not very good because it's not very big here. So let's use this. Okay, we'll go back to Microsoft. It's the same thing. The underlying equity price, spot instrument, and options on that underlying asset, the equity price. And this is obviously options. Okay, so as the equity price declines, option prices rise. Okay, now option prices rise. If you remember when we discussed this, some of the things you have to remember is that call, and I've told you this before, we haven't come to discuss this relationship yet, but there is something called put-call parity, and there is no arbitrage relationship between puts and calls. So there's a relationship called put-call parity, which links these two prices. So given the call option price and given certain other values, you can find the put option price. That's why option models, the main output of the option model is actually the call option, and then using put-call parity, you work out the put option value. So these two are connected. Okay. So what is happening here is the logic is like this, that as equity prices start to decline, okay, the investors, so there's an assumption that equity prices, so we should understand this whole thing in detail, okay? So make sure we understand this in detail. The explanation lies in hedging behavior, okay? Assume, okay, most investors are long, which is not a very erroneous assumption actually. Most equity investors are long only, okay? So they don't go short. So most equity investors are long only. If you remember this term, long only, this means that you're not allowed to go short. So we assume that most equity investors are long only, all right? So what happens is that as and generally fully quite heavily invested, okay. So they're investors, so we assume that when they're invested, we don't have to put that as an assumption. So what happens is as the equity price falls, okay, these guys are obviously showing losses on their portfolio. You follow that? Okay, if they're showing losses on their portfolio, okay. So now let's ask Akshita, since she's not on mute. Okay, Akshita, what is, if you start showing losses on your equity position and you don't want to sell your stocks, what can you do with options to hedge your position, to hedge your losses? What kind of options would you buy or sell? As you know, you have 4 options. You have 4 alternatives. You can buy options, you can buy puts, sell puts, buy calls, sell calls. Now, which of these 4 would you choose to do if you were in this situation, you are long, you're heavily long on Microsoft, and the Microsoft stock starts to decline, but because for you may have many reasons why you don't want to sell your underlying, because one solution, of course, is to just cut your losses and get out. Okay, but let's say there are many reasons why you don't want to do that. You want to hold on to your stock, but you want to hedge against, you want to protect against the loss of value of your stock portfolio. So my question is, if you're not, let's say I'm not allowing you to sell your stocks, but you're very worried because the stock price keeps declining and you're worried that it will decline a lot more. Okay, now I'm not allowing you to sell the stocks, but you want to protect against the loss of value of your stock portfolio. So my question to you is, out of these 4 option positions that you have 4 alternative in the case of option. Like there are 4 types of option positions. You can see them here because there are 2 types of positions, buy and sell, and there are 2 types of options, call and put. You combine them, you get 4 types of option positions. Now, in this kind of a situation, when this is declining, you want to protect against the loss of value. Which of these option positions would you want to put on? Yes, Akshita? We'll come to Utsav later.
Sir, I'm not sure.
You take a guess. I mean, you understand my question, right? You understand my question?
Yes, sir.
Okay. So, what do you think? What kind of, think about this way, think about it this way. Let's help you here with the logic, which will help everybody else also. That your objective is to protect against losses in the value of your stock portfolio. I am not allowing you to sell the stocks. So you know the stock portfolio is going to keep on declining. So what you need is something where you're going to basically, you need some kind of position which is going to make money when stock prices decline. Okay, because that will offset, if you can have a position as a hedge which will offset what is happening on the stock portfolio. That means as the stock portfolio declines, stock prices decline, the portfolio will lose value. So you need something which will gain in value as stock prices decline. Okay, so now if I give you that additional piece of additional hint, now which of these 4 positions will give you that result? That as stock prices decline, it will make money for you. Which of these 4?
Sir, sell call.
Sell call, okay, that's good. That's one. Anything else you can think of that will make money for you when stock prices decline?
So I think it's sell call only.
Sell call only, okay. We have a couple of participants. We'll put Utsav because he had his hand up earlier.
Sir, you earlier mentioned that we are not allowed to sell the stock. So that is one of the restrictions. So going by that, we are left with the option of either buy call or buy put. And since our underlying asset, that is Microsoft, is on a bearish trend, that is the stocks are declining. So according to me, it should be buy put.
Okay, so you're saying buy put?
Yes, sir.
Akshita said sell call. Now 1 minute, I'll just come to the rest. 1 sec, just give me a second, okay? One second. Just a second. Okay, let's listen to the other responses. Okay, so we've heard Akshita, we've heard Utsav. Now I see Vipul and I see AA. So we'll go with Vipul first.
Yes, sir. Sir, we can either buy put or sell call.
Okay. Buy put or sell call. Okay. Then double A.
Yes, sir. Same, sir. Buy put or sell call. First of all, buy put.
Buy put or sell. You are saying you prefer to buy put.
Yes, sir.
Okay. All right. Okay. We have 3 participants with raised hands. We have dealt with Vipul and double A. Then we've got Sachin. Yes, Sachin.
Sir, when we don't allow to sell the stock, then we need to buy a put.
Okay.
First.
Okay. Then next is Mitali.
Sir, buy put and sell call both, because if you have said we can't sell the stock, like with that restriction we can go with only buy put, otherwise the both.
Okay. All right. Okay. Okay. Good. So I've got these responses. Just give me a second. Okay. Okay, we have one more chat box here. Okay, sir, I will buy put. Aman. Okay, Aman also wants to buy put. Okay. So we have both Amans answering. Okay, I think this is good now. We'll just we'll continue now. I don't need to lose more time on this. So we'll continue. So that's a good thing that we can see from many people. We have, you're right, that theoretically the 2 things you can do, and the answer is already there in this matrix itself, that when the underlying asset price view is bearish, okay, you can either buy put or you can sell calls. Okay, buy puts or sell calls. Now you can see here there's also another clue for you here, which is what is the context in which we are discussing this kind of problem. We are saying that there is a intermarket correlation, and historically there is a tendency for a inverse relationship to develop between underlying asset prices in equities. Okay, in equities there is a tendency for a inverse relationships. Okay, an inverse relationship here between moves in the underlying asset, and so I won't put this underlying asset. In this case, underlying asset is Microsoft stock that we are discussing, and IVOL index. Okay, so these two, there is an inverse relationship. This is the context in which we are discussing this problem. Okay, so you already know that in this context, the information that you have is that the stock prices are likely to be declining, and you're not allowed to sell the underlying asset, the stock portfolio. You can't liquidate it. So you need to do something, but you're very worried about the losses that will happen. You need to basically protect against the losses. So you need to set up something which is going to gain in value as stock prices decline, because the portfolio will lose value. So if you have something which gains in value, so that will offset the portfolio losses. And because of this peculiar context in which we are having this discussion, you also know that eyeballs are likely to rise. Okay, so you know that information as well. So here we can see now, say where Akshata could, I think she also mentioned briefly that buy put she prefers. But if say somebody is, a little bit confused between these two, there is a way to solve that confusion by taking note of the fact that in this particular context, we are discussing a situation of inverse relationship between underlying asset prices and option prices. So we know that the eyeballs are likely to rise. So if you go back to your matrix, initially you thought you were in this row, okay, but you were not sure about the column. So you said both buy put and sell call. But now you notice that you have some additional information. You also know that eyeball view is bullish, because eyeballs are likely to go up. So now you know that you are actually able to place yourself between these two columns, you can place yourself in this column. And that's why you end up with this solution. And you can almost, remove this solution actually. You end up with this solution. Why? Because as you can see here, and when eyeball is likely to be going higher, moving higher, and the underlying is bearish, then the right solution is to buy puts. Okay. So what happens here? So everybody's clear. Any questions here up to now? Everybody follows the logic?
Sir, I have a question, sir.
Yeah. Yes.
Sir, if we don't have, sir, calls, then we can sell it on the first place.
Sorry, come again.
Sir, like in equity, sir, we can sell a share, then buy it. We call it, sir, short selling, sir. First we sell the share and buy it.
Yeah. So yeah, that's right. So short selling is sharing.
In options, sir, there is, I think, sir, there is no short selling, sir.
Where?
Sir, in options, we cannot first sell the call and then buy it.
No, you can sell options also. You can sell options. That's why you get bid and offer prices. If you look at your TWS option trader, you are getting bid and offer prices, right? So nobody's stopping you from selling options, but you'll have to maintain a margin, right? And they will be marking that option position to market. So you'll have to maintain a margin. And so that's what you'll be required to do. So you can, and they will be checking what is happening to the market. If you sold an option when the price was 3.8, and then tomorrow the price goes to 4.2, they'll ask you to pay the extra money that you lost. So
margins are daily basis they cut the margin.
Sorry, come again.
Sir, we have to maintain the margin, sir. I know, sir.
Correct. So if you've sold, you can sell options, you can go short options, but and in your project as well, you're allowed to do that. I am allowing you to do that. You can buy or sell options. But obviously, if you sell options and it starts to lose money, the position, you will have to pay up the money on a daily basis. Whatever you lose today, you will have to pay it up tomorrow morning, early morning. Okay. So it's the same as a stock or a futures position. Your losses will be recovered from you on a daily basis. And your profits will also be, if you make money, you can also take out that money and that will be paid to you on a daily basis.
Sir, I have one more question. Sir, why will one sell a call if there is a put option available? Like, sir, they work in different manners. Sir, call option will benefit when when the price will go up, and sir, put option when the price go down.
No, I didn't understand your question. You're talking about in this situation, why should we sell calls?
Not in this situation, sir.
In any situation.
Sir, yes, sir. Suppose, sir, for index, sir, I am trading, sir, for an index.
Yeah.
Sir, suppose, sir, for Nifty, sir.
Yeah.
If, sir, I want to buy a put, then the Nifty, if Nifty will go down, sir, then I will go for a put option.
Yeah.
Sir, so why one will sell call at first place?
Because, as I said, you see where the sell call is located. Sell call is at the intersection of eyeball bearish and underlying bearish. So if you feel that the eyeball here is going to go down, okay, and so basically remember the way the logic works is that you have to think about it in different ways. You should really apply the framework that I've taught you here, is that when it comes to option trading, you should first think about your this position, okay, here. The first is, should I be buying or selling options? That's not written here. It's written higher up, further up there. I'm not going up the notes so much. But the first decision problem is, should I be buying or selling options? For that, you take a view by take a view on the eyeballs. You need to take a view on the eyeballs. First thing you should do in option trading is to find an eyeball chart for whatever options you're trading. Okay, and then take a view on the eyeball charts. That means you look at this Now what's going to happen to eyeballs? Are they going to go up or are they going to go down? That straight away puts you in this or this column. Okay, if your view on eyeball is bullish or bearish, you go into one of these two columns. And then, of course, there are two rows in each column. So which row should you select? For that, you go into the next decision problem, look at the underlying market, look at the chart of the underlying market and form a view on the underlying market, right? So directional view, here also directional view, okay? And so you form, the next step is to do that. So if you should approach it in that way. Otherwise, it may become a little bit confusing. So if you find, so the answer to your question, Vipul, is why would I ever sell a call? You would sell a call if you have this combination of views. If you're bearish on the eyeball and you're bearish on the underlying asset, okay? So the reason, what you're saying is that I would always prefer to buy a put. That's not really true, because if your view is bearish on the underlying, but also bearish on the eyeball, if you buy a put, okay, remember what eyeballs do. Eyeballs are the index of option prices. So if eyeballs keep going down, like here, all option prices, both puts and calls, will decline, okay? So if your put price also declines, so here you're not getting a double whammy in terms of a benefit. Here, okay, fine, since you bought a put, the underlying asset goes down in price, so the put becomes a little more valuable. But because you bought a put and you're long an option, here what happens is you're long an option, and if eyeballs are going down and you're long an option, eyeball view is bearish, so all option positions are also losing value. All options are losing value because eyeball is going down. So therefore, rather than do this, you are better off over here, because you're selling the call. As the call, if the underlying goes down, then the call becomes more and more out of the money, okay? So it's like here, okay, you sold a call. Let's look at it here. You have an underlying price, and these are the situations, okay? Let's say here you have a bearish view on the underlying and a bearish view on eyeball. Okay, so let's move this rounding to 2. And let's move the eyeball to a very high level, 75. Okay, and let's make it this way. So here, okay, we can see the answer to Vipul's question, and after that we'll come to Mithali. So here we can see that, so here's the price. Now 871 is, you notice this price, okay? We'll just look at the calls. Oh, we have to look at both actually. So we can make a note of these, 871 and 838. So roughly about 8.4, 8.7. Okay. Now look at it here. If you have a bearish view on the underlying and you have a bearish view on the eyeball, one option is to sell the put. Maybe we should take a note of this. We can keep a note of this here. 871, 838. We should actually do it in today's, we'll do it here, then we'll move it later on. Okay. So now let's see, we change, now what we do is we make the underlying drop very sharply, okay? So let's see what happens. If we make the underlying drop to, let's say, 60, okay? And we make the fall also drop. What is our view? Bearish on eyeball, bearish on underlying, okay? And we make the drop, we make the, where is this? Okay, here. So we make the underlying and we make the eyeball drop to 25, okay? Now what did we do? Now we have new prices. Eyeball has dropped to 25, underlying has dropped to 60, and what are the new prices? 0 and 39.64. So this was call and this was put, right? Okay, so this is 39.64 and this is gone to 0. Okay, so now you see where is the gain, which has more gain. Okay, exit price minus this, and this is the same as this. Now notice one thing, you were talking about selling the call. So this is actually a profit for you because your call position is a minus. So this actually is because the underlying position size will be, the number of units will be shown as a minus sign. So this will become a profit. In both cases, you're making money. You see that, Vipul? Okay, so this question is a very good one actually. It helps us to see in real time. We look at an option valuation model and we look at the new fair values, and you can see that this, of course, you ignore the minus side because we haven't put the number of units, because this call is a sell call, so it's a short position. So that would be put in with minus X number of units. So minus minus will become plus. So there is a profit in both cases. But which is making more money? Now you can see the answer to your question, Vipul.
Yes, sir. You are saying, sir, in both the cases we are making money.
Yeah, but you're making more money in the buy. No, what did we actually do here? We looked at a bearish situation, right, where you sold calls. Okay, you sold calls and you put actually. So this example actually validates your point. What you're saying is that you have bought. You would prefer to buy puts, and I was forced to this solution. Okay, so maybe this is not a good example actually. You can see, but theoretically we should always be going into this block because the loss of value in terms of the drop, because of driven by the drop in the eyeball, will actually be more beneficial to your position if you have sold a call than if you had bought a put. In this particular case, it's not working out. It's not a good example, but the theory still points to this as the better solution because you are consistent in the sense that your eyeball view is bearish, so you should be selling options, and your underlying asset view is bearish, so you should be selling call options, not put options, because the put option will lose value. If you sell put options, the put option will actually gain. The put option will gain in value here. It will gain in value if the underlying price goes down. Okay, so therefore theoretically this is still the preferred option. Okay, so I have not chosen a good example. This is not a good example, but I would still tell you to follow this logic because it's consistent with the theory that if the eyeball drops, option prices in general will fall. So you should not be buying options when you have a bearish view on the eyeball. This is clear.
Okay, sir. Sir, basically you are saying that this will help in decision making if I follow this.
Yeah, this framework is logically consistent that if you have a bearish view on eyeball, because one of the things you can see is that as the eyeball drops, the prices of both the options, has dropped, because this one was worth of course the time value of both the options has dropped actually. This option has gained in value because of the change in the intrinsic value. Okay. If you look at you can now measure, you can further break this down in terms of change in intrinsic value. Here, the change in intrinsic value is $40. Okay, so you can see that there's a change. Here, you can see the intrinsic value has dramatically changed by $40. That's why this option the call option has effectively gone to zero, because the intrinsic value of the call option, which was actually mathematically zero earlier, has now become minus 40 mathematically speaking. So effectively we write that as zero, but actually mathematically it's minus 40. And so that is so much negative. That's so negative that at this low level of eyeball, the time value is very limited. Okay, but one of the things you can notice about this is the time value, the intrinsic value of the 100 put when the underlying is at 60. The intrinsic value of the 100 put, how much is that? If we ask somebody, how much is, or I'll just tell you now because we won't waste more time by asking people. Well, the intrinsic value is $40. Okay, so one of the things you notice, Vipul, is your option price is worth, it's almost running on negative time value. Can you see that? because your put option price is actually the intrinsic value is $40 clearly, because you can sell at 100 by exercising and then square it at 60. But your option value is actually, the time value is almost negative, is actually negative on this. So this value is, although it is more money than this one, but still it's because of the drop in eyeball, your time value has collapsed quite dramatically. Okay, if you go back to the original example, if you look at the original price, which is we had 871, 838. Okay, now what has happened here? If you look at what was the, if you remember, what was the underlying?
Underlying is 100,
And this was 75.
75.
Okay, so although this is not a good example, but I'm giving you the once again why you should be focusing on the matrix that I've given you. Here you notice, Vipul, what is the intrinsic value of the put option here?
0.
0, correct. So therefore, what is the time value of the put option?
8.38.
8.38. Okay. So now here, if you now plot its intrinsic value and time value separately, you will see. Okay. Here, intrinsic value is 0. Here also, no, I've not. This is not a good. The display is not correct. But the point here is that at this point, yeah, the intrinsic value was 0 and the time value of, actually it should be under the calls, under each of the scenarios, okay? But you understand what I'm trying to say, that here, the intrinsic value of both the call and the put was 0, okay? But each of them had over $8 of time value, okay, because of the high level of the eyeball. So what is happening in this case is that once here the put option intrinsic value is here the intrinsic value is actually 40 and the time value is actually negative because of the sharp drop in the eyeball. So that's why I say, so essentially what has happened is, here you had 8.38 of time value, okay? Here we'll actually we'll say it's actually 0, we'll say, okay?
Yes, sir. Exactly.
The value has collapsed. So this is the reason why I'm telling you to be in this framework, because see, what happens is, this underlying asset price can move dramatically. This can move dramatically up and down, as you can see here. You can see in this price, okay, it can move up and down dramatically. So the main point of option trading is also underlying, of course, you have to capture the intrinsic value, but mainly trading of options is based on eyeball movements, which really deals with the time value. So therefore, you're still better off following this matrix, because if you were bearish on the time value and you had actually sold, if you had sold a call following your bearish eyeball view, then what happened is that the time value of this call has actually collapsed. The time value of the call has collapsed, and the time value of the put has also collapsed. Both of them have collapsed here, the time value. Okay.
Yes, sir.
That's why I'm saying, so that gives you a better understanding of why I'm saying that you should still be in this box. That if your view is bearish, your underlying asset view is bearish, you should be in this box, not in this box. Yes, now you understand better?
Yes, sir.
Yeah, so it's a good question, because it helps us to see through the intricacies of this thing and makes you understand once again that option trading is essentially all about time value mainly, and managing the movement of the eyeballs, okay? Especially when you're trading options in the way that I'm allowing you to trade, because I'm not allowing you to touch the underlying. You are only allowed to buy and sell options. So you're riding this curve, okay? Yeah, okay, sorry. Now we come to Mithali. Sorry about that. Yeah.
No, sir. My hand was, I forgot to lower my hand when you asked the question.
Okay, no problem. All right. So let's continue here. Okay, so we had some feedback about questions, handling of questions after the class, etc. But this kind of question, say from Vipul, I have dealt with it inside the class because it is directly related to what we are discussing. So if it is slightly tangential, then I will discuss it later. Okay. But this one was very important. Actually, it's a good question because it helps us to understand the nuances of option trading and how the time value collapses when the I wall collapses. So the time value of the option is very important, as you can remember also from our earlier discussion in the previous class, that we don't want you to exercise options even though you have an American option, American style options. So don't say American options. It might actually make people think that you're talking about options trading in the US market. Okay, all of them are not American style. So when you say Americans, make sure you always practice this good speech habit here for option trading. Always say American style, which means immediately people will understand. The moment you say American style, people will understand that you're referring to the exercise style. Okay, so that's why we say that even when you have an American style option, you can exercise early. Don't do it because you will not be capturing the time value. All right. So it's a good question. So I have kept it inside this discussion. Okay. So let's go on to the next point. And so the point that I was trying to discuss here. Okay. So we had a long discussion, but it's good because if we keep it, we keep you guys on your toes. So one of the things we assume is that most investors are long only. Okay. So, and that's one, we assume one thing. Okay. And yeah, so they are long only and not a long term and long term. So long-term investors, so they don't want to, most equity investors are, let's put it this way, long-term and long only, all right? So, and they don't, so long-term and long only, so they are just making it once again, this long-term and long only. They don't want to sell their long. This actually follows from the first one, actually. I don't need to write the second one, but I'm just writing it. They don't want to sell their equity holding. So these are the two constraints, that you are long only in equities and you don't want to sell your equity holdings. So the fall in the underlying, so they seek to protect. Now you understand. Now you'll understand whatever I'm writing because we've already had the discussion. So they seek to protect the impending loss of value of their equity portfolio by buying put options. Okay. Now you understand this. This I don't have to explain now because we already had the discussion. So what they do is, since they're not allowed to sell their equity holdings, many times they have this kind of mandate constraints and stuff. So they want to protect the value of the portfolio by let's introduce this concept of hedging. You get an introduction to hedging, which you'll be doing in your next course. By hedging, by how do you hedge? By buying, in this case, by buying put options. Okay. And why you buy puts and not sell calls, that we have already gone through that discussion, by buying put options. Okay. Now this leads to, I'm going to write it now like this, leads to, okay. This creates, let's most equity investors, okay. So I have to put one more thing here. this case the stock prices, is expected they seek to protect the implied. So you're fearing this underlying asset price, the stock price is going to fall, and you protect the pending loss of value of the equity portfolio by hedging. How do you hedge? By buying put options. When you start buying put options, this leads to excess demand for put options. Okay. When you have excess demand for any asset, what happens to the price of that asset? Again, I'm not going to waste time asking you, but you remember from economics that when there is excess demand for any asset, this will lead to a rise in the price of put options. Rise in put option prices. Okay. Now, by the put, you will not understand this right now, but essentially understand that there is something called put call parity, which forces puts and call prices to remain together. It is kind of like if yogurt prices are going, let's say if milk prices are going up, then eventually yogurt prices have to go up because yogurt is made from milk. So there is a connection. You can't have the two out of line. You can't have milk prices going up 40-50% for several years and then yogurt prices remaining constant. It doesn't work like that. So therefore, yogurt prices eventually have to start moving up. So there is a relationship between put and call prices called put-call parity. By the put-call parity relationship, okay, what happens is that call prices also rise. Okay, so a rise in put option prices leads by the rule of put call parity to rise in call option prices also. Okay, so I'm giving you the full logic here and we have had the discussion. So make sure you go back and understand it later. So rise in call option prices, okay, also. Okay, so this is reflected, okay, rise in the eyeball index. Okay, so this is what is happening. You can see here. Okay, so if you see this, why is this happening? So now we have an explanation for this. This phenomenon, you will see this, and people talk about it a lot more than they should be talking about it because it's not sufficiently reliable for trading. But it does happen from time to time, and people talk about it a lot. So you should know this as finance students, as people trading equity options. So essentially what is happening, so if somebody asks you, why do you think this happens? It happens because this is dropping, investors are fearful, they as a hedge, they start buying put options. This creates excess demand for put options that raises the price of put options. By put call parity, it raises the price of call options also. All option prices are rising, which means essentially the eyeball index of those options is going to rise, and that's why you have a rise in eyeball index options. As the market starts to recover, the demand for hedging goes down, and so the excess demand for options falls away, and prices start to return to normalcy. This is the logic behind this. Okay, so we have given you I've given you the stepwise logic. Make sure you understand all parts of this. This is reflected in the rise in the eyeball index. Okay. Later, as equity prices rise, hedging demand abates, excess demand for options also abates. Abates means falling away, okay, retracing basically. Hence, eyeball index declines, okay. So this is the situation. Now we have already understood this point. So it's important for you to be aware of this relationship, and we have had a good theoretical discussion. It helps you. We have had some interesting discussions because of the questions that were asked. So make sure you understand this. I've given the entire stepwise logic here. Again, always remember, do not so there's your 12:45 lunch break. I'll let you go in a minute. So remember, always just one warning. Make sure you revise all the stuff that we have done today. Understand it, and understand it conceptually. Don't memorize. Okay, if you memorize, you'll get into all kinds of problems. If you understand it conceptually, you will feel better, and you will never forget it in your whole life. Okay, take care. Okay, have your enjoy your lunch. The class is dismissed, and you can leave. And those who have questions can stay back, and I will take any of the conceptual questions first, and then I will deal with administrative questions. Yes, Vipul?
Yes, sir. I have one question, sir. Sir, if we buy options, suppose, sir, I am buying, sir, option for Nifty, sir.
Okay.
And sir, currently, sir, suppose, sir, it was trading at, sir, 13,000. And
Okay.
sir, I want to buy option for 13,500.
Okay.
Why there is a difference, like the option is cheaper for 13,500, and sir, if I want to buy option for suppose 12,500 call option, or sir anything call or put option, sir, why it is, sir, price higher than 13,500?
No, the answer is again the same old very important formula that I taught you, that option premium is equal to what are you saying here? Exercise prices 13,500. Now it's not cheaper if you're buying a put. You're talking about index is 30,000.
Yes, sir.
And your exercise price is 30,500.
Exercise price means, sir, it's not, sir, exercise price, sir. Options, if you buy options, sir, they were showing key for what point you want to buy an option.
Yeah, that's that's a strike price, right?
Yes, sir, strike price.
Strike and exercise is the same.
Okay.
Strike price, exercise price is the same. So you're talking about underlying is 13K, exercise price is 13.5K, right?
Yes, sir.
So, and let's take 30 days to expiration. Vol, let's keep vol a little bit more normal. Let's keep it at 50 or something. Okay. Yeah. So you notice that the call option. What are you saying now? You're saying that. You're saying, if I understood you correctly, you're saying. You're saying that if you're looking at the 13,000 call, you were looking at this one is actually an out of the money call, right?
Yes, sir.
This
But I'm saying that if the index was at 13,000 and I want to buy a call option of 13,500, then it will be cheaper than 12,500 option if I want to buy.
Yeah. So the answer to your question lies once again in intrinsic value and time value. So we can maybe shift this discussion here. I don't want to clutter this framework, and we can take this here and go back to today's session board. We can have a session board here, and here we can have this. Today is 11:25. Is that right? Yeah. Okay. So we can paste this one thing here. That was one discussion. Now you're talking about if your underlying asset price is, so well, let's put it this way, the price, if you look at, let's take the call option. Your question is about the call option, right? That
Yes, sir. Yes, sir.
13.5K call is cheaper than the 12.5K call when
Yes, sir.
underlying is at 13K, correct? That's your, right? So if we write if we see here, the answer is completely in the, so if you look at the, call strike, okay, call strike, okay. is 12.5K. So I'm just going to write 12.5, okay? And I'm going to write 13.5, right? So you're looking at two different call strikes, okay? Underlying is 13 for both. Am I right?
Yes, sir.
So underlying is 13 for both. You're looking at the two different call strikes. Okay, 12.5, 13.5. Let's look at the actual prices. The 13.5K call option is 549 point. We'll ignore the decimals. Okay, so the premium is what is it?
549.
549. Premium in the case of 13.5 is 549, and in the case of 12.5 we'll make this exercise price equal to 12.5, and we'll calculate it, is 1028, 1029. Okay, so your question is, why is this much cheaper, right? That's your question, right?
Yes.
Okay. Answer lies once again in, of course, the general answer is very simple, because out of, that's just a quick answer, that out of the money calls are cheaper than in the money calls. The thing is here is that what you're seeing here is that this call is in the money because the underlying is here. This call is in the money, this call is out of the money. So you can actually see one more thing here, which is this call is ITM, okay, and this call is OTM.
OTM. Okay, sir. Now it is clear, sir.
It is, so now let's make it even
Sir,
more.
I'm sending the link. Can you open this link and explain this example with the real example? I'm sending the link in chat.
Yeah, I got the link. I hope it doesn't open my Firefox. Yeah, that's exactly what it is doing.
Right click and copy the link and paste in the Chrome.
Yeah, I'll copy the link. Okay, so it says select all. Okay, let me just see. No. So I'll come to that. I'll explain it, Sachin. Let me just explain it first theoretically, then I'll explain this also, okay? So let's look at this. Very simple. Let's look at the intrinsic value for the in the money call is 0.5. Is that correct? 0.5K. Obviously, this is in 1029. But let's look at it. The intrinsic value for this call is 0.5. Correct? You can make 0.5, and the intrinsic value for this one is 0. Okay, and so this is the difference in this. Obviously, this is, we have put it in thousands. So this, you can see here, if you write it, instead of writing it in 12.5, we write 12,500, 13,500. Okay, and this one is 13,000. Is that right? 13,000. Okay. So the intrinsic value here is the and this one, the intrinsic value is 0. Okay. So the fact, you can see straight away logic. I want you to always use this conceptual framework that option premium is equal to intrinsic value plus time value. Okay. Time value, we can say roughly should be the same for both calls and puts. Okay, doesn't always happen, but it should be the same. Sometimes they're using different eyeballs. So, but theoretically, it should be the same. So if you see here, now what is the time value of this? The out of the money call, you can straight away see that, because the out of the money call, the intrinsic value is 0. And the premium is 549. That means the time value is 549. Correct?
549. Yes, sir.
it should be equal to the same, it should have the same time value. If you add the two, it is coming to 1049, it's 1029. Okay, so there is a slight difference in the time value of the two. Okay.
Yes.
So this is basically the framework that you should always use. That intrinsic in the money options are worth more because they have some positive intrinsic value, and all options should approximately have the same time value with the same strike. And
So basically, difference is in the intrinsic value.
correct. So the explanation comes from the difference in the intrinsic value, and this is the framework that you should use to understand the difference. Okay. Now I'll come to the link that Sachin has said. So does that answer your question, Vipul?
Yes, sir. Sir, I am asking this question because, sir, in practical life, sir, it is very difficult to think. Like, sir, if we are trading.
No, but now do you feel more confident that you can now?
Yes, sir.
Yeah.
Yes, sir.
Yeah. So if you use the framework that I've given you, you use the option trading framework I've given you. This is the right way to look at it. I don't know if you can get charts for eyeball. You can use India VIX charts as a proxy. Okay. But essentially, what you need is you need to have some eyeball charts so you can have a view on the eyeball, and then you should place yourself in this particular type in this box. Okay. Appropriately, okay, and then so we have this. Okay, now we'll come to Sachin's question. So I have taken the thing that he has sent me. Now, what do you want to look at, Sachin?
No, sir, I want to understand the same example, with this real life question. Same question with this.
So which one do you want to focus on?
13,000. 13,000. The current Nifty price is 13,000. So below the 13,000, after and under and above the 13,000.
Okay.
Go down.
Strike price. Okay.
13,000.
9898 13. Yeah. So you can see here also they have the shading system. Okay. They usually shade the in the money options. Okay. So you see that these below 13,000 strike, these are in the money calls, and above 13,000 strike, those are in the money puts. So the puts are shaded on the right. Okay. So the example that Vipul gave us is 12.5K. So we have 12.5K. We can take 12.5K. Okay. And the only thing is we have to know what is the expiry date, usually about 1 month or so. Where do we have?
If you click on that 12,500, it will show the expiry date.
Yeah. Let's click on it and let's look at. Yeah, so there are multiple expiry dates that they have taken in understanding the thing, but that's okay. Let's go back to this. Let's look at the. Let's see what they have here in terms of whether they have an eyeball index or not. 12,500. Okay. Do they have an eyeball index? Okay, so yeah, eyeball they have not listed for this. Okay. 12.5. So they've got bid price, ask price. So it's roughly, you can say 12,500. They've got a bid price, ask price. Say about 535. Okay, 535 roughly, we can say ballpark. Okay, 536 or something like that. 535, 536. So we can now put the price as 12.5. We are putting the price as 535. Let's say 535. Okay, and what is the other one? Where is the other one? Here. And so this is 12.5. But we took the right one, right? 535. Yeah. And the other one is 13.5. Let's take 13.5. 13.5. You can see they have given the eyeballs for this also. Actually, 13.5. The 1 minute here. We have the LTP, the last traded price, 12,500. Let's take the last traded price. 12,000. Okay. 5 147, but now the price has dropped. Anyway, we'll take the current price. We'll take the mid of the bid and ask. You see the last traded price is outside the current bid and ask. 13 and a half. Let's look at 13 and a half. Okay, 13 and a half. The last traded price is 1.5, but here the price is 145, also 147. We'll take it as 147.5, 147, 148. Okay, so that price is 535 and 148. Make sure we have the right prices. This one, 13 and a half, the price is 145, 150. And here the price is 12,500. The price is 535 roughly. Okay, so 535, 148.50. Yeah. So now let's understand. Now the intrinsic value is still the same. Okay, the intrinsic value is still the same. Because the strike minus the underlying. Okay. In this case, it's underlying minus strike, but obviously you have to go through the logic. Don't memorize the formula. It's underlying minus strike here, so the intrinsic value is 500, and this one has intrinsic value of 0. Okay, so here the time value is 148. Now the difference, of course, is that the time value here should be 148. So the price, the fair price of the put should be not the fair price of the put, but the fair price of the 12.5K call should actually be. But here one more thing is, we are looking at calls. Make sure we looked at call prices. Yeah, we looked at call prices on this side, right? We were on this side, so we looked at call prices. Yeah. Okay. So this here you see the imperfections of this market, because it's not sufficiently liquid and you don't have enough opportunities for maybe arbitraging the prices. But the fair price, you can see here application of fair value models in arbitrage kind of situations. Okay, where the fair price of this call, of this 12.5K call, should only be actually, this is your fair price model. Okay. This is your fair price model, and the fair value of this 12.5K call is actually 501.5, but it is trading in the market at 535. In fact, the last traded price is 547. Okay, now it is trading at 534.5, 536.90. So you can, if it is right now higher than fair value. So as an arbitrager, the fair value is this. So as an arbitrager, you would sell this call at 535. Okay, but the problem here is that in order to make this arbitrage work, you need to do some trades in the lending and borrowing market, and also a trade in the put option. So now you have to see the put option price and make sure this arbitrage works. So that kind of calculation we'll do once we look into put call parity as a relationship. But straight away it gives you an idea that in an underdeveloped market like India, there are some prices which may not be in line. So these prices are out of line, in the sense theoretically the price should be this. But as you saw, even in the case of using the option valuation model, the prices are not exactly the same. So rough cut theoretical prices, but the departure here is too much. From 501.5 to 535, this is too much difference actually. But we have to see whether we can successfully make an arbitrage profit. For that, we need to look at the prices of puts. We need to look at that we can find from NSE prices, but we won't have data on lending and borrowing interest rates. At what rates can I lend or borrow money? So that will become a problem, but we can look at that. When you're in a position to run an arbitrage desk, you will have information on that as well. So for the theoretical framework for that arbitrage, we will have to look at put call parity first. Okay, so we'll do that once we cover that.
Okay, sir.
Yes, Sachin, are you clearer now?
Yes, sir. Yes, sir. Yes, sir. Little bit clear, sir.
Good questions. Actually, the questions are very good, because it shows that you guys are actually tinkering around in the real world, and playing around and actually thinking about what is being taught. Okay, so that's good. Okay, so anybody else, any conceptual question?
Sir, I'm still confused about the metrics that you taught us. Sir, for hedging and for speculation, do we use the same metrics? Because our view for the underlying assets is gonna change. Like when we are speculating, we would have a view that, for example, we have a bullish view on our underlying asset, and so that we can take a decision from this metrics. But for hedging, our view is gonna be different because earlier we were bullish, but now to hedge for hedging, we would think that the underlying asset may the trend may go bearish. That's why we are hedging, right? So wouldn't it change our process for these two, like
Yeah.
for hedging and speculation?
As a short answer to your question, the matrix remains the same. Whether you're hedging or speculating, but this is a decision matrix. So the matrix remains the same whether you're hedging or speculating. Now, the difference is that the part of the reason you're having a confusion is you're feeling a little bit confused is because you have not looked at the two decisions at the same time. Okay, you are taking the underlying asset decision at some earlier point of time. Okay, maybe here where you were bullish on the underlying asset and that's why you went long. Okay, now in this kind of a situation, here what happens, we are looking at typically institutional equity investors who are long-term holders of stock, and they are long only holders of stock. So for these guys, they don't really have much of a choice. If they have some investor capital coming in, I mean, they do have some choice to remain in cash. Sometimes you may hear discussions about people remaining in cash. But in general, they do not have much of a choice. So they need to get into the market because that's what they're being paid for. Okay. So what they do is, okay. So what they do is they look at so they don't have much of a choice. So they tend to go long equities. But you're right in that just the fact that you're going long equities immediately allows me to conclude that you have a bullish view on the underlying asset, and that's why you're going long. Okay, so in that you're correct. But you have to notice that the time at the point of time at which these decisions are being taken is different. The reason that the same matrix applies is that if you put yourself on the same point of time, say somewhere here, where you are now fearful that the stock market will decline. Now, at this point of time, the way you take your decisions is the same, whether you're speculating or hedging. Now, if you are one of those people who had already gone long at this point, now you're no longer going to be speculating at this point because you already have a position. So at this point, you are in the situation of a hedger. But someone who has not had a position from before is coming in square to this point will be acting like a speculator because he does not have a prior position which he wants to protect. Okay, so I think it will become a little clearer to you if you put yourself at the same point of time. That bullish view on the underlying asset happened much earlier, and that's why you went long. And you have been carrying the long position, and now you are here, you fear there will be a decline, but you don't want to sell your equity holdings because you don't want high turnover. You're a long-term investor. You just want to have a hedge. But if you're a speculator, you're coming in with a square book to look at this market. And now another thing you should do is put yourself at the same point of time and focus on the same market instrument combination, which means you're really focused on option trading. So at this point of time, when they are focused on option trading, both the speculator and the hedger will think in exactly the same way. Because they're focused on option trading, first they will take a view on the eyeball, and they will have a bearish view on eyeball because they'll have a bullish view on eyeball because they are bearish on the underlying asset. Okay, so they have a bullish view on eyeball. So immediately they are put in the position of buying options. whether they're hedgers or speculators. And because they're bearish on the underlying asset, they will end up buying puts. So here the answer to your question is it does not differ in any way. You have to put yourself in the same point of time. And the only difference is that the hedger has an existing position. The speculator starts with a zero position. Okay? But the thinking process is exactly the same. That's why the matrix is also the same. Okay? Are you following? Does this make sense?
Yes. Yes, sir. At earlier point also, when we were bullish and we were bullish on the underlying asset, and we took a position there, and when we are hedging also, then we'll also take the same decision there.
Yeah, same.
Right, at an earlier point of time.
Here the view has changed. You see, at this point we were bullish on the underlying asset. The view has changed in the sense there is a slight difference in the investment horizon for the two views. You see, at this point, a typical institutional equity investor, they go long because they have a long-term bullish view on equities. Whereas here, the bearish view that is there on equities is typically a little bit more short-term, but still you can see here that although the period of decline is quite small, time-wise, the price decline is quite massive. Okay, so they're not worried that there will be a very prolonged decline, but there may be a sharp decline in prices. So they want to hedge against. So there is a slight difference in the time frame between the two views. Okay, but that's essentially the difference. Yeah, does that make sense?
Okay, and yes, sir. And so one more thing, like I understood that for a later point of time, but sir, at an earlier point of time when we were going long, when we were taking the decision to go long, and when we were bullet on, yes, sir, here. So, sir, there also the person the investors will hedge their hedge, thinking that if my view is wrong, I might be able to cover some risk. So, sir, for that purpose, wouldn't his view be different for buying the options, buying or selling options?
No, what we are saying, the case that we are discussing, the particular story that we have made up in this case, in order to discuss this situation, in that story, when the person is going long equities initially, he does not have a fear of the market going down. So at this point, the question of hedging does not arise in his mind. So the story that we are sort of creating for ourselves in order to understand this whole inverse relationship and why there is an inverse relationship according to the theory. In order to understand that, in that story, we at the earlier point of time when he decides to initially go long equities, we do not imagine that he has any kind of bearish view or fear of the market going down. At this point, he basically thinks the market is going to do fine. And so as an institutional equity investor, when he receives money, he has a tendency to be quite heavily long in equities and having very little in cash and bonds. Okay, so cash and bonds, it's almost, for an equity investor, is almost kind of interchangeable. You put some money in treasury bills and stuff like that. But essentially, we just talk about equities and cash for an equity fund investor. So at this point of time, the story is that he does not have any fear about the market. The fear about the market arises at this point of time. And that is how we set up the hedging process and the relationship between the two market instrument combinations. Does that make sense?
Yes, sir. Yes, sir. And sir, for a change, like if the person wants to hedge from the start, he'll take the positions as if he can take the positions for options as if he had a position there at an earlier point of time. So the decision will be same there too. Would that be correct?
If you wanted to hedge initially itself, then what you would do, you would buy like 100 shares and you would buy one put option. Okay, and so then in that case you're fully hedged. So if you buy 100 shares, okay, at whatever this price, $120, okay, and then you buy one put option contract at the money, then that means you're long underlying asset at 120 and you're long the put option at 120, which means if the price goes below 120, then you don't lose any money on a net basis, right?
Yes, sir. So okay, so for if in the starting it's simple that we buy either a put, if we are a short position we buy a call. But sir, after like in the story that you told us, we need to look at the metrics, eyeball, and all the parameters.
Correct. For the if you are just buying, if you just want to be fully hedged, you don't really even need to look at the matrix. You just need to figure out what is the position that will have the opposite P&L performance. So you don't even need to look at the eyeball. There's no need to take a view. If you want to be 100% hedged in the beginning, okay, but eventually, so in that case, you don't even need to look at the matrix because you're going long the stock at $120 and you want to create a hedge which will completely offset any profit or loss that you have on the stock position, right? Then you just, for that you don't need to look at the matrix or anything. You just need to know what is the profile, P&L profile of a put or a call, and the P&L profile of an underlying asset long position. So you're going long, you need some offsetting position. So you straight away know that the offsetting position for this one is a long put. So if you have a long asset and then you have a long put, then you are fully secured. You can't lose any money. But remember, you can also not make any money. You don't make any money also. It's fully hedged. Once you're fully hedged, you don't make anything, you don't lose anything. Okay. So as we will see, as we get into the next module, I think if I'm not mistaken, our next module is payoff profiles. We'll have some discussion about that, and then we will have look at synthetic equivalent. So you will see that actually, if you have long underlying and long put here, this is the example that we discussed. If you have this, it is effectively like being a long a call. So this would be inefficient to do. It could be more efficient to buy a call because these are the same, these are equivalent positions. Okay, so we will have this discussion going forward. Okay, and so in the next few sessions we'll have these discussions. So you see the concept of equivalence, yeah. But you have to remember that if you hedge yourself fully, then after that you don't make any money and you don't lose any money.
Okay, so sir, investors won't hedge from the beginning, but the companies looking to reduce their risk from market fluctuations or interest rate or by other foreign exchange risk. So they'll hedge from the start to reduce this risk. Is that correct?
Correct. Because see, for companies and all, when companies are hedging, we'll have some more of these discussions when we get into IFM. You'll get more clarity there in the next semester. That when companies are hedging, that is exactly what they want. They don't want at the point at which they hedge. They don't want from that point onwards. They don't want any profit, and they don't want any loss. They don't want any more changes. They want to lock in whatever is there in terms of value. They want to lock it in by hedging, and then they want a situation where after they hedge, there will be no profit and no loss. But investors usually will not have that kind of view, because investors, then why would they invest if they don't want any profit and any loss? They actually are willing to take a loss, and they keep some risk. And so if you are fully hedged, you don't keep any more risk. But investors will keep some risk, because without that you can't make any money. So directional speculators, let's call them directional speculators, or let's call them just speculators. Even market makers carry some positions, right? So we need to distinguish between hedgers and speculators. The objectives are different. Hedgers are looking to eliminate all the risk and lock in everything, whereas speculators are looking to keep some risk and hopefully make some money.
Okay, sir. And sir, one more question, sir. Earlier when the when the prices plummeted. I read about the news about the Mexican government. They always have so much positions in derivatives that they don't get affected by the price changes much. And they in the news it was that they pay a huge premium for that. So
Yeah,
I wanted to learn more about that. Is that a prudent decision that they do?
yeah, you're talking about the Mexican government, right?
Yes, sir. Yes, sir.
Yeah. So yeah, they have a very active oil hedging program, very sophisticated oil hedging program. So yeah, that's correct actually. So in fact, you can send me that. I would like to also read that article because I want to collect more information on the Mexican hedging program. So wherever you read it, where did you read it?
During the lockdown, sir, but I'll on in journal article on the news site. I'll search it and I'll send it to you.
Find it, just send me the link. Yeah.
Okay.
So yeah, so that's
And sir,
general answer is yeah, that's a good thing to do for them actually. Yeah.
and sir, one more thing, sir, I have an account opened with SMC during my internship period. So I was looking at their reports. They have this research reports published for the customers, and sir, they have this metrics for derivatives. I couldn't understand that. I'm not able to send you the PDF file on Zoom here. If you could look at that, you could tell me more about it.
Maybe you can email it to me.
Okay, sir. It has the sentiment indicator, Nifty versus OI, and FII, foreign institutional investors activity. But I don't understand that how it helps us in making the decision, and why they put this in their research. Like if I was at AMC, why would I use this to for the investors?
Yeah, you can send me. You can email me the PDF, and then we can look at it.
Okay, sir.
Yeah, we can look at it later because anyway, it looks like that kind of material will not fall under our normal coverage in the course, in the options course. So we'll cover it after the class.
Okay, sure, sir.
You email me the PDF where we can look at it.
Yes, sir. I just sent you the email.
Yeah. Okay. All right. Okay. Anything else? Anybody else?
No, sir. Thank you, sir.
Okay. All right. Okay. So no other questions. All right. Okay. So we'll close.
Thank you, sir.
Welcome.